What causes recessions, and are we approaching one or even in one? Today, we're diving into recessions, those economic slumps that can shake markets, jobs, and your wallet. Ever wonder what really causes a recession? Is it skyrocketing oil prices, runaway inflation, or maybe a crash in consumer spending? And what's this yield curve inversion that people say can predict and even cause a recession? In this video, we're breaking it all down from how federal funds, interest rate, and the bond market move the economy to why consumer confidence and stock markets play a huge role via hyperfinancialization. This is part one of a two-part series, so stay tuned for part two, which will illustrate how many of these traditional dynamics appear to have been broken in the past couple decades and how it all lines up with our silent depression thesis. So I think part two will be really interesting. I have it already prepared, but I don't want to make this video too long. So first of all, let's just define a recession. So a recession is a period of time defined by the National Bureau of Economic Research, NBER, as a period of time in which the economy is shrinking. Generally speaking, you are seeing negative GDP growth, meaning overall economic activity is not only not growing, but it's actually shrinking. Generally, you get falling prices, or what's what technically known as deflation, where prices are falling, and generally you get a spike in the unemployment rate. So jobs are being cut, jobs are being lost. And so here is one of the causes of a recession. WTI oil, West Texas Intermediate oil. This is in logarithmic form. I will show what regular scale looks like. So just so people have a bearing. I think logarithmic is important because it can show us the real degree of a move upward. And what we can see is that oil spiked before the 74 recession. Oil spiked before the 80 recession. It went from $15 a barrel all the way up to $40 a barrel. It's almost a 3x increase. Even here, the 1990 recession, oil went from $16 a barrel all the way up to $36 a barrel, right? It doubled. That would be equivalent of $120 a barrel now. Even before .com, which people think of as a tech stock led recession, and to some degree it was due to hyperfinancialization, which we'll get into in the second part. But look at what oil did. It went from $12 a barrel all the way up to $34 a barrel. So it basically 3x'd. And the same thing is true for 2008. While, yes, subprime mortgages and the housing market and all of that was a huge driver of the GFC, look at what oil did. It went from $19 a barrel all the way up to $128 a barrel. So oil goes into everything. Energy is an input into everything. And what happens, remember, especially in the modern globalized economy with globalized supply chains, that factory in China needs energy to build the trinket. They also need to pay the worker to come to work every day. Well, if he's got to fill his car up with gas and gas is going up, and then the trinket gets made, then it needs to get shipped across the ocean by a cargo ship, and those use huge amounts of oil to get it across the sea. Then it gets to the port, and it needs to get to the distribution center, which takes, again, a truck burning oil. Then from the distribution center to the final retailer, right? Hopefully it is clear how oil goes into everything. Energy is an input into everything. And what can happen is what's called demand destruction. So as oil gets more expensive, eventually people just can't afford to pay the higher price, or they can't afford to get in their car to go on the vacation because the price of gasoline is just too high. And it's not just gasoline. Demand destruction can occur with anything. Prices get so high, right? This is the other side of inflation. The only cure for high prices is high prices. It's kind of a saying in economics for a reason, which is, the way you get deflation is by everyone deciding the world is too expensive. I can't afford to buy it, so I'm not going to buy it. And so economic activity, GDP contracts, economic activity slows way down. You get a recession. In a recession, prices come down, and voila, you fix the higher prices. So here, though, I will take oil off and show consumer confidence. So consumer confidence is just what it sounds like. This is the degree of confidence that consumers have. And what, again, I want to show is that consumer confidence peaks and then starts to fall way before a recession. Here we can see it peaked in 72. The recession didn't even start till 73. Here again, it peaked in 1977, started to fall before the recession of 1980, and so on. You can see this. Why this is important is consumer confidence, as we'll see in the next slide, is directly correlated to consumer spending. And the last point I want to point out here, a huge degree of the American economy overall is consumer spending. I think it's like 65%. This is really a really important channel in recessions is consumer spending. And the other point I want to point out is we are currently at a reading of about 51, 52 in terms of this consumer confidence index. Look at how many times that has been reached going back all the way to 1970. Consumer confidence has basically never been this low. It was here back down at these low 50 levels in the great inflation of 2022. This was when CPI inflation was 9%. And then it was here again in 1980. And there were all sorts of issues going on then. But generally speaking, we have seen very low consumer confidence readings. The final point to point out with consumer is that while it's a huge portion of the overall economic output, that we have such a K-shaped economy, such a bifurcation in the modern economy over the past 5 years, that 50%, half of all of consumer spending is done by just the top 10% of income earners. So we have created an economy that is completely reliant on how are the rich doing, how much are they spending. If you are a lower middle working class person, your spending, your activity economically doesn't even really register in terms of the overall economy. We know that the lower 80%, 90% of Americans have been struggling mightily. You know, people are working 2, 3, 4 jobs. Everyone's got a side hustle, right? There's all sorts of issues kind of that we know about. You can have very, very low consumer confidence readings, but consumer spending kind of overall, right? If the top 10% are doing okay, in fact, if they're doing better with the conditions, then, you know, their spending could theoretically prop up the overall GDP, the overall consumer spending. So it's not to say that I condone that. I think it's a horrible thing, but it is an economic reality. And so here is producer price index inverted. Remember, producer price index is one way to measure inflation. It is a leading indicator of inflation. Inflation shows up first in the PPI, then it does the final kind of consumer price inflation. This is inverted. So as the red line is going up, prices they're either decreasing, they're either going down. As we saw in August of 2009, we printed almost -7% producer price index. Things were falling for producers at 7% annualized rate, 7% cheaper per year. Or as this red line goes up, it means that prices might still be rising, but the rate of change is slowing down, right? So while maybe last year prices were rising 5%, this year they're rising 2%. And so that is highly correlated, as we can see, to consumer confidence. And this hopefully makes intuitive sense, people hate inflation, and their confidence will be lower in periods of time where inflation is accelerating, right? As we can see here, inflation accelerated, producer price index increased, right? Because it's inverted, and consumer confidence fell. And sure enough, they bottomed at the same time. There was a very tight correlation here, kind of in the 70s. It has gotten slightly less, high correlation, slightly more noisy. But in general, the direction here is what matters. So as producer price index, as the prices are rising at a fast rate, as we saw during the last administration from, say, 2021 to 2023, right? Producer price index went as high as like 10, 11%. Well, during that period of time, consumer confidence plummeted. And we talked about how the current readings of consumer confidence are at levels basically not seen in modern history. Here is consumer spending with a 9 EMA smoothing. I'm going to take off producer price index here. This is actual consumer spending, quarter over quarter growth rate. I kind of smoothed it out with a 9 exponential moving average because it's a very noisy data set. And hopefully this correlation is even more clear. Consumer spending, as consumer confidence goes up, consumer spending also goes up. It actually goes up. As consumer confidence falls, you can see that consumer spending slows down or even goes negative. So here's S&P 500 in logarithmic form. Again, I will toggle real quick just to show this is regular form. So logarithmic form is adjusting for that exponential. And then here is, we're starting to get in the bond market and how, what might be causing the recession. Outside of oil, outside of consumer confidence and therefore consumer spending, we're going to start to look at some other causes of a recession. So here's the S&P 500. And what I want to point out with that is, especially as the economy has become kind of so hyper financialized, the S&P 500 can actually cause a recession. And we'll get into a lot of these dynamics in part two of how kind of all the traditional way of thinking about the modern day American economy is totally broken, and we're kind of in this brave new world that no one seems to fully grasp yet. That'll come in part two, but store this away. The S&P 500 peaks before the recession even starts, right? We can see that going back all throughout history. Here, like for example, before '08, the stock market peaked in the summer of '07, and the recession didn't start until February of 2008. So 6 months or so. And also, I would, even though the NBER didn't define it as a recession, we did have 2 consecutive quarters of negative GDP growth in 2022. We did have an inverted yield curve. There were political things at play. Unemployment didn't really spike, so NBER decided not to declare a recession for 2022. But if they would have used the traditional definition and not changed the definition on us, that would have been true for 2022 too. The stock market peaked before we started getting those negative quarters of GDP, those 2 consecutive quarters negative GDP. Here is one of the yield curve spreads. Here in red, we're taking the 10-year yield and subtracting the 1-year yield. Now, generally, the 10-year yield should be higher. You're taking more duration risk, more inflation risk, right? There's more convexity with these longer bonds. So you should be getting a higher interest rate. And anytime the red line is above the dotted red line, we can see that that is, in fact, the vast majority of history is a positive, uninverted yield curve. The inversions, these inverted yield curves that people talk about, are a very good signal for a recession, right? The yield curve has inverted, gone actually negative, right? Where you're getting higher interest rate at the short duration than you are at the long. It has inverted before every single recession. You can see that going back, at least to the 70s. You can see that the yield curve inverted before a recession. There are reasons why this is happening, and those reasons can actually drive the actual recession to happen. So, a lot of people will look to this inverted yield curve as kind of a signal, but it's actually even deeper than that. It can be causing the recession, and we will get into that slightly later. I do want to just briefly note here we have again the spread between the 10 and the 1 year. Here we have the DXY dollar index. Generally, as the reserve currency issuer of the world, we actually see dollar strength during recessions. We can see, especially the double dip recession, we got mega dollar strength. This is generally not what you see in the vast majority of economies. Generally, during a recession, their currency will weaken. And I actually think that during the next recession for us, the dollar will weaken. And that's maybe a whole different video. But the point here is I can't find a correlation, at least, between just this simple spread and anything for the currency, really at all. Now, the reason for this is because you can get an inverted yield curve or steeper yield curve. You can get that one of 2 different ways. And those 2 different ways are hugely, hugely important. Are you getting a bull steepener? Or are you getting a bear steepener? Because those represent 2 totally different things. Also, finally, I do want to just say why a yield curve inversion can happen, right? Why is this actually happening? So what a yield curve inversion is talking about, here we can look at the one before 2008. So we can see we were in a Fed hiking cycle. This white line is the federal funds rate. It was going up. And we can see the 2 year and the 3 month, which are yellow and orange lines, the shorter maturities, they basically followed the federal funds rate. And in fact, up through here, we actually got those short term rates, like the 1 year interest rate, higher than the 30 or the 10, right? That is an inverted yield curve. It's just another way to visualize what we were looking at here. And you can get this for two reasons, right? When it uninverts and you get more yield for the longer maturity, right? The purple, which represents a 30-year, that yield did come down during 2008 during the cutting cycle, right? But what happened was the yellow and the orange line, the short maturities, those started to fall super quickly, right? Very, very rapidly. The 10 and the 30 were falling. You can see that, but they weren't falling nearly as fast. So why is that happening? Well, remember, the short-term maturities, all they do is kind of predict or lead the federal funds rate, that overnight interest rate the Fed controls. If you think the Fed is about to start cutting interest rates, you want to buy the short-term maturity because we established that it moves way sharper, right? That's a bigger move. Maybe it might be helpful to invert this, right? This is the value of the bond. So you can see the value of the 30 and the 10, they did go up, right? Into the 2008 recession. They did. If you bought the 30-year, the 10-year here, you did make money. Your bond became more valuable. But look at what the shorter maturities did. They got way more valuable, way more quickly. And again, this is because they track the federal funds rate. So what happens? The bond market is trillions of dollars. It's a huge amount of capital. And people are betting constantly in the bond market. If enough people, here is this kind of wisdom in markets sort of theory. The wisdom of markets dictates that, you take a million different market participants around the world throwing around trillions of dollars of capital. They are incentivized to make money. They are incentivized not to lose money. And so if they see a chance to make money, say on the 2 year treasury, by buying it before the Fed starts to cut rates, if they do that, there's a profit incentive there. They will buy the shorter maturities they will pour more money into those shorter maturities, buy them much more vigorously, which will cause the bond price to go up and therefore the yield to come down very, very sharply. There's not as much of an incentive for the longer maturities, right? They will go up in terms of value or go down in terms of yield for sure, but they will, the real profit incentive here is to catch a Fed cutting cycle. And the other point here to note is that the Fed, another kind of signal, I guess you could say, I will take off all the maturities here. We will only look at the federal funds rate in the 3 month, which tracks the federal funds rate. What we can see is going into a recession, the Fed is hiking rates, right? And remember why they're hiking rates. They're trying to cool the economy. And we can see that the Fed hikes and eventually rates get so restrictive, things start to cool off, right? Whether it's GDP or inflation, which is kind of sort of one and the same thing, economic activity slows down and eventually it kind of gets nonlinear. And the Fed has to really cut rates really, really quickly to respond to the recession, to the economic slowdown. But look, every recession has been characterized by a period of time, a hiking cycle where the Fed is hiking interest rates. And we can see, they have hiked rates. And again, that kind of potential recession in 2022 that was sort of, but not really, that was, a lot of people were pointing to this particular thing going, well, we've been in a hiking cycle. Every hiking cycle causes a recession. Oh, I did want to point out one thing here. Here is real GDP on a quarter over quarter basis, and then a 9 EMA smoothing. Just because you can tell there's a lot of noise. Here, I wanted to show those two consecutive quarters of negative GDP here in March of 2022. And then again, it was ever so slightly negative in the summer of 2022. So sometimes, depending on the frequency of the GDP data that you look at, sometimes it can look totally different, right? A year over year might not register. If GDP rebounds like it did after into 23, GDP rebounded very sharply. That pulled up the annual GDP growth number, so you don't see a negative print on that annual GDP growth rate, but you do see it on the quarter over quarter, which is a much more high frequency data source, but it's also more noisy. And then again, down here, you can see the inverted, the yield curve spread. But what I want to point out is something I think is just interesting given the video that we just did, is that the yield curve inverted before 2019, the 2019 repo crisis that we did the video on. So the yield curve actually inverted here in August of 2019, predicting, again, a recession and a cutting cycle by the Fed. The repo rate crisis happened in September of 2019, and then everyone knows what started to happen in kind of December, January 2019, 2020. Like, people have pointed to that and gone, did the market really predict all the events of the early 2020s? I don't know. I think it's just an interesting data point that the yield curve inverted back then, and to some degree kind of predicted not only the repo rate crisis but the coming events of 2020. That's one of those things is just kind of spooky that I think is interesting. Here is three different yield curve spreads. So you're taking the 30-year yield and then subtracting different maturities. This is just kind of a different way to hopefully visualize this to really help people. So the blue line shows the 30 minus the 10. And you can see this is one scale over here. You can see that it doesn't move kind of as sharply. The 30-year yield minus the 5-year yield, which is slightly shorter maturity, you can see it moves more dramatically, right? But what really moves is the 30-year minus the 2-year. Hopefully, this is a good way to really illustrate that it is the shorter maturities that move very rapidly and cause the yield curve to invert and then uninvert. So here's the 2-year minus the federal funds rate. We have talked a long time about this particular dynamic that the Fed appears and pretends to be all powerful, but is really not that powerful. They just follow the 2-year yield. And here is a way to kind of visualize that up top is taking the 2-year yield and subtracting the Fed funds rate. And I think what's interesting is, again, it bottoms at the start of a recession. Like the 2-year yield is indicating by going below Fed funds, below this dotted yellow line, what this yellow line shows is the difference between the red line, which is Fed funds, the actual Fed funds, and the white line, which is the 2-year yield. This yellow line is showing the difference between the two of them. It's just a different way to visualize the same data. But you can see, right, when this goes negative, what that means is the 2-year yield is actually falling below federal funds rate. And again, the kind of market wisdom theory that the market is smart enough to kind of predict that a recession is coming, and they go and they buy the 2-year, which drives the yield down lower, actually, even than the federal funds rate. Sure enough, the Fed has to cut rates. The 2-year yield, the curve uninverts, and we can see what happens to the same goes for a hiking cycle, I would say, where the 2-year yield starts to kind of go higher above the federal funds rate here, right? Predicting a hiking cycle by the Fed. So it's just two ways to visualize the same data. Remember, this is a real thing that is happening, right? When the yield curve inverts or uninverts, it is due to trillions of dollars in the bond market moving around in a certain way. And before a cutting cycle, right, what is happening is a huge amount of money is piling into short-term rates. Here is just the 2 and the 30, the 3-month and the 30-year. So very, very short-term and, very, very long-term. And look at the difference, right? Like the 30-year fell in 2008. The yield fell for sure. The bond rallied. But look at how much the short-term maturities, fell in terms of yield, or put another way, rose in terms of value, right? So there is a degree to which this dynamic with the bond market can actually cause a recession. And this is what the commenter has been, I think, trying to get me to do a video on. So here, just to establish it very, very quickly, we have a levered system. We only have about 5.6 trillion in terms of the monetary base. But if you look at M2, which is a more broad way to measure the money supply, it is like 4x levered, right? The system, even just the monetary base to M2. So a lot of money in the modern US economy is actually created by private banks. A lot of people don't know this, but we established the monetary base. The official money is only 5.6 trillion. Well, a private bank like JP Morgan, right? You go to them and you say, hey, I want a mortgage on $1 million house. They go, okay, you do some paperwork, look at your income. They write $1 million loan. Well, to them, that loan is their asset and your liability, right? They just created $1 million out of thin air. Basically, private banks get to do this. When they write a loan, when they extend credit, they're basically creating money out of thin air, recording that loan or that debt as an asset for them, and it's your liability. So a huge amount of the dollars, quote unquote, in the system nowadays are private bank credit. We already established that even the official kind of M0 to M2, even that's 4x levered. Once you start looking at all the dollars in the modern day US economy, we're talking like 10, 15, 20, 30x levered. So I think it's important to look at the banks. And so that's what this yellow line is showing. This gets into how the bond market can cause a recession. Here we see JP Morgan plus US Bank plus Wells Fargo, and then I took an average divided by 3, and we can see the performance. Again, it peaks before recession, right, and shows weakness before the recession actually hits. And here's again that same yield curve spread that we've been looking at. Well, here in blue is total loans and leases by private banks. So this blue line indicates that total amount of money, private bank credit that we just talked about, how much of that is being created, and then you're dividing it by the US M2 money supply. So remember, M2, this is like a more official kind of government metric or government side of money. Total loans and leases is that private bank credit, which makes up a huge amount of the overall money or dollars in the system. And what I want to show is that total loans and leases, when the Fed would hike rates, it used to, private banks were issuing more, generally speaking, right, over time from the early 70s all the way up until 2008 when things started to break. Again, we'll get into this in part 2. You can see total loans and leases were growing faster than the government money was growing, right? You can see that over time, total loans and leases was outpacing M2. And that is why this blue line goes up. Well, things broke in 2008. We'll get into that in part 2. But not only do the banks start to decline before the recession, not only that, but total loans and leases also do. So I'm going to take off here. I'm going to take off the stock price of the banks. Here we're just looking at total loans and leases divided by M2. Remember, as this blue line is going up, the banks are issuing more money. They are issuing more credit into the economy than the government is, right? Than the official M2 money supply is growing. They might both be growing, but total loans and leases by private banks is growing faster. Well, look at what happens. It peaks out. This particular metric peaks out again before the recession. And then what happens? Private banks stop extending credit, right? That is what this is indicating. Private banks, that private bank credit stops growing. We can see that going back kind of during the pre-broken era. Private banks start to pull back on their credit issuance. And the reason for this, it coincides with the yield curve inversion. Because the very, very basic way that a bank functions is they borrow short and they lend long. Because we established, generally speaking, the yield curve is positive, sloping. The inversions are the exception. And so if you're a bank, what you can do, let's say here let's pick a random time, 2002, what this is indicating is that you could borrow 1-year debt, right? and then issue a loan for 10 years. And your interest rate, right, as the bank, is 2.75% lower than that loan that you extended to some family to buy a house, right? So that 2.75% is your profit, right? Because you were able to lock in debt at the short end of the yield curve, right, at say 1 year, and then issue a loan, a mortgage, let's say, to a family at a higher interest rate than what you borrowed it at, right? So you borrowed the money for 2.75% less interest rate than you are charging them. Well, what happens in a yield curve inversion? Actually, your whole business model breaks because now it costs more money to borrow short and lend long to that family, right? That family is actually benefiting because long-term interest rates are actually lower than the short-term ones, which is not how it's supposed to be. And again, you can kind of see this with total loans and leases by private banks divided by M2. But hopefully, now that you understand the very, very basic way that a bank makes profit, it also makes sense that a yield curve inversion not only gets the banks to, because again, now there's no profit for them to lend. When the yield curve is inverted, they have no incentive to grow their total private bank credit. They have no incentive to extend loans and leases and basically create economic activity or print dollars. And so they stop. And we can see that reflected in the blue line. Well, it just makes sense because it becomes unprofitable for them to do so. They pull back. So less people are getting mortgages and therefore buying houses and contributing to economic activity that way. Less people are buying cars and credit card spending, right? And all the ways that private bank credit can stimulate economic growth. Well, just as quickly when the yield curve goes inverted and it becomes unprofitable for the bank to do it, they stop doing it. And so here, finally, we'll wrap up here. Part two will come next. Here is just I think a really to tease out part two. Here's the financial sector divided by the S&P 500. And so what we can see, you could kind of see it in this first line here with total loans and leases divided by M2. Something clearly broke, right? This was in an uptrend for decades upon decades. This was how, private bank credit was growing faster than M2 money supply. Well, we broke that uptrend. And in fact, total loans and leases have been falling relative to M2 money supply. And here's kind of another way to tease that out. So here's the financial sector, right? All the stocks that represent the financial sector divided by the S&P 500. And what you can see is 2008 was brutal for them. On a relative basis, the financial sector fell 65%. The S&P 500 fell, right? But the financial sector fell 65% more. And look, it has just gone sideways. I mean, you could even call that a downtrend. They never recovered. The private banks, something happened in 2008, and we'll get into this in part two, and we'll end part one here. But anyways, hopefully that was helpful. And yeah, stay tuned for part two, which I think will be really interesting on the kind of silent depression, what's going on, why things broke, how it's being run now, and how that's different from everything we just looked at. All of that will be coming in part two. Hopefully, part one was helpful, and hopefully you will come and see part two, which I think will be even more interesting. So I'll catch you in the next one.